Hello, friends. In the recent past, we have a lot of discussion about the long-term capital gains, and in the budget there has been some changes, and people have created a controversy, particularly in WhatsApp and other places, and in the media, social media, whether it is really so bad. I have a different opinion, and I wanted to speak about the same. Hello, I am Salil Ramesh Chandra. I am an activist. I have also written a book called Where to Invest, When to Invest, How to Invest. Let us proceed with the slideshow. So let us go to the earlier long-term capital gains tax, how it was implemented, and what are the advantages, disadvantages regarding the same. If the property was purchased before the year 2001, and then would have been valued at the ready reckoner rates of 2001. After this year, if you are selling your real estate property, there was the indexation benefit. The index was on account in the inflation of goods and services. So it is to be noted that it is not on the capital appreciation of the property, but it was based on the goods and services. So if how it works. So for example, the index base year is 100. Then in 2020-21, the index was 301. That is almost three times the valuation on the of the 2001. Now, if you look at this, the property prices may have gone about 4 or 5 times or 10 times or something like that. But you would get only a indexation of three times that. So it was not a real valuation of the property. It was based on goods and services, and that was at a lower inflationary rate, whereas the appreciation of the property was much higher. So there was a wrong mechanism that was being used, first of all, in the appreciation or indexation of the property. So based on the valuation of the property in the year 2001 and the indexation, the current value or the value at the time of the sale was derived. The property so derived, value so derived, would be reduced from the actual sale price and the balance value was taxable. Now it was the balance value was taxable at the rate of 20% of the long-term capital gains. To give an example, if supposing if a property was valued in 2001 and the RR rates was at 6 lakh rupees, and there was a sale in 2021 for say 1 crore rupees, then the valuation of the property would be 18.06 lakhs based on the indexation of 3.01 of 2021. The taxable value is 81.94 lakhs and the tax was 16.39 lakhs. So from 1 crore we have reduced 18.06, which is 81.94 lakhs, and the tax was of 20% was 16.39 lakhs. So let us now go to what is the new long-term capital gains tax. In the new tax regime, there is no indexation, but valuation of the property would be done at 2000 RR prices. Therefore, the taxable value is sale price minus the valuation of the year 2021. The tax as per the budget of 2024 will be 12.5%. So now there is a reduction of from 20% to 12.5%. From the earlier example, that is of 1 crore valuation sale, and 6 lakhs, from there 6 lakhs will be reduced, and 94 lakhs will be the taxable value. So taxable value would go up from 84 lakhs approximately to 94 lakhs. And 12.5% of 94 lakhs will be 11.75 lakhs. Therefore, you will be saving 4.64 lakhs in the new regime. So why are the people being scared by the social media? I feel there is some problem in this, and we'll take it further from here. So what is happening is that the wrong data can be misleading. I saw some wrong data and information being spread. The example I gave earlier was in real life, but any wrong data which is not in real life can be misleading. So basically, it is a mathematical manipulation that happens. For example, if the valuation in the earlier example is shown as say rupees 25 lakhs in the year 2001, then the indexable valuation in the year in the earlier regime would be 75.25 lakhs. based on the 3.01 indexation, and the tax would be 4.95 lakhs. The calculation is given there, and which is much lower than the earlier valuations. The manipulation is done by showing a lower unreal sale value or a higher purchase value. So, if you manipulate mathematically a higher unreal sale value or a higher purchase value, it can lead to a misleading data. So let us understand what are the implications of the new long-term capital gains tax. In my opinion, largely the tax will be lower or almost equal than what it would have been from the earlier regime. The problem that in the new regime is that if one has to invest in the government bonds for saving the long-term capital gains tax, then the larger sums have to be invested in these. The indexation gave the benefit of lower taxable amounts, which would have resulted in lower investment in these bonds. These bonds helped in reducing the tax or making it almost nil. In case if one is buying a new property, then there is no difference between the old regime and new regime. So basically, one has to invest more in the bonds in the new regime. If you are going for basically a new property, then the benefit would be the same. There is no difference in this. So I am giving a table of difference between the earlier regime and the new regime. Supposing this tax is the implications of the tax we have to understand. Now, first of all, the indexation is based on consumer price inflation, and real estate appreciation is based on actual real estate appreciation. So there is a lot of difference between the real estate appreciation and the consumer price inflation. CPI for 20 years has been approximately about 5.65%, and whereas the real estate appreciation is around 10 to 12%. So there is a lot of difference between these two appreciation, and consumer price inflation was not the real inflation on the in the real estate. Now I have given an example where 1 crore investment in 2001, and what would be the indexation at 5.65%, and what would be the actual appreciation at 10%. So supposing 1 crore investment in 2001 would result in 1 crore 31 lakhs as per the old indexation value, and the appreciation actual based on 10% value would be 1 crore 61 lakhs. And the tax in the old regime would be 6 lakhs, and in the new regime would be 7.625 lakhs. After 10 years, the tax would be in the old regime would be 17.2 lakhs, and in the new regime it would be 19.8 lakhs. After 15 years, in the old regime, the tax would be 37.8 lakhs, and in the new regime, it is 39.625 lakhs. After 20 years, the tax in the old regime was 74.4 lakhs, and in the new regime, it is 71.5 lakhs. Now, one has to understand that indexation is based on consumer price inflation, which will not go more than 5 to 6%. Whereas appreciation of the property is much higher, it is around 10 to 12% always. And therefore, the actual inflation is not being taken into account in the consumer price inflation. So that is where the difference is. Based on this data, one can see that if the appreciation of the property comes down, the taxation would come down, in fact. Also, uh, if you see from the data, the taxation is around the same as what would have been in the old regime. In the new regime and the old regime, there would not be much of a difference. So let us do a summary of the discussion we had so far. From the above table and the earlier example, it is difficult to say that the new regime for long-term capital gains tax for properties would increase the tax. It will vary from case to case. In some cases, it will be less if the property is purchased prior to the year 2001. In future, if you have to compare the new tax with the earlier one, the variance in the amount of tax will depend on the appreciation of the property. So basically, the percentage of the growth in the appreciation is more important in future.